There's a room in London. No cameras, no audience, just a scheduled electronic auction that happens twice a day, every business day. On that auction, a group of major financial institutions establishes a benchmark price for gold. Not a suggestion, a benchmark. That number becomes a global reference point used across the financial system, from jewelry pricing to ETFs to central bank accounting and large institutional contracts. This process has existed in different forms for over a century, yet most people who own gold have never heard of it. Today, we're going to break down how the price of gold is actually set, not the myths, not the marketing, but the real market mechanism behind it. Because once you understand it, you start to see gold very differently. Gold has recently reached new all-time highs. Central banks are increasing purchases. Investors are increasing allocations. Even digital asset investors are paying attention to gold again. That raises an important question. If gold is supposed to be a long-term store of value, why does its price change every second? Gold doesn't produce earnings. It doesn't upgrade. A bar of gold today is chemically identical to a bar of gold from thousands of years ago. So why does its price move so frequently? Because gold is not priced only as a physical commodity. It is priced as a financial asset through markets, contracts, and benchmarks. The primary benchmark is called the LBMA gold price. Twice a day, authorized participants submit buy and sell interest through a centralized electronic auction system. The system searches for a single price where total buying interest matches total selling interest. That price becomes the official benchmark for that session. This typically takes only a few minutes. That benchmark is then used globally across contracts, funds, and institutional accounting. Historically, regulators have fined some institutions for misconduct in this process, which led to reforms and increased transparency. However, the structure remains centralized, and participation is limited to approved institutions. Most people don't realize there are effectively two gold markets: the physical market, where real bars and coins change hands, and the financial or paper market, where futures contracts, ETFs, and derivatives represent exposure to gold without physical delivery. The paper market is far larger and more liquid. Because of that, the paper market often determines the global quoted price. If you buy physical gold, you typically pay a premium over that quoted price. This reflects real-world costs, such as refining, transport, insurance, and availability. Some analysts estimate that paper claims on gold significantly exceed available physical supply, although exact ratios are debated and not publicly verified. Central banks hold large gold reserves. They also engage in lending and leasing programs, where gold may be temporarily loaned to financial institutions. This can increase effective supply in the market without new mining production. Details of these programs are not always fully disclosed. As a result, central bank activity can influence gold supply and price dynamics in ways that are not always visible to retail investors. Gold is often described as a hedge against inflation and financial instability. Over very long periods, it has tended to preserve purchasing power. However, over shorter periods, gold can be highly volatile. Its price is influenced not just by physical supply and demand, but by interest rates, currency movements, central bank policy, futures market positioning, investor sentiment, and geopolitical risk. That means owning gold is not just owning metal, it is owning exposure to a global financial market. There are scenarios that could affect how gold is priced in the future: increased demand for physical delivery, large changes in central bank policy, shifts toward alternative regional pricing benchmarks, structural changes in futures and ETF markets. None of these are guaranteed, but they highlight that gold pricing is shaped by financial infrastructure, not just mining output. Gold is often viewed as something outside the financial system. In reality, its price is deeply embedded within it. The metal itself doesn't change. What changes is the collective market consensus around its value. The price you see is not the intrinsic value of gold. It is the current agreement of market participants, and that agreement is updated every day. This content is for educational purposes only and does not constitute financial advice.